from data is sometimes the data is so condensed and so like definitive that people miss things that they don't think can happen. Like I'll give you a good one. This like stable coin blew up like this week.
So, okay, it is crazy that you brought that up because I was going to bring something similar to that up, something called the stock to flow model, which is basically what
the Bitcoin model.
I'm sure you've heard that shit, the stock to flow model, right? And basically it's pretty accurate in its assessment, right? Except the only things that the model cannot predict is like the market sentiment or like disasters or like, it can't predict these things. So that's why you'll see big dips in the chart when you compare them side by side.
Right.
As the stock to flow model is basically taking the amount of Bitcoin that will ever exist divided by the rate at which you can mine it at, right? And that's the same model that we use to predict the price of gold.
What do you define like as a disaster?
As a disaster, like a recession, or like
COVID,
the COVID or like the crypto boom and all that shit. Like people talking about it more, like media hyping it up more and more and more. Like the stock to flow model doesn't calculate or analyze those things because it cannot predict those things. But what it can predict is it can follow that formula, which is basically just divide the amount.
To tell you where price is going to go and like what the levels are.
Exactly, yeah, and it's just like a rough indication of where.
And what
the
does
price
that currently say about Bitcoin?
It's way off right now. It's way off. It should be. I think it should be like at 180,000 or like at 100,000 right now. And right now it's at 25.
Okay, so
30,000, 30,000, I think, 31,000.
25 to 30.
It's 30.
Yeah, and it hit the lowest. It hit 26,000.
Yeah, when Luna and also like what's the other stable coin?
When Luna, and then just go back to stablecoin.
Tether was kind of breaking the.
Oh, Tether. Yeah. Tether is, I heard, is one of the biggest Ponzi schemes. It's about to blow.
If Tether blows up, Bitcoin's fucked. But anyways,
why do you say that though? Like, I'm really interested in.
Two key things that we have to bring up. So one, I'll just hit quickly on Tether. Tether is the equivalent of dollar within the digital ecosystem.
Okay.
Mm-hmm.
And so people don't want to take their like investment outside of cryptocurrencies. And so they use these stable coins as like a proxy for being in the dollar, which is like safe, which is like what stock traders do, right?
Exactly,
if I'm an investor, I think that the market's going to crash. I put all my money in dollars. When crypto investors or like traders, they think that crypto is going to crash, they put their money in a stable coin. And I think there's like weird shit going on with
and the reason why they put their money in stable coins, because a lot of these stable coins like Tether, USDT, or like Luna specifically are going to be like they're valued at like, it's $1, it's always going to be $1. It might go down to like $9, like 99 cents or some shit, and then they'll keep like trading it, and they'll make somebody will put a lot of money on that penny essentially, and they'll make a lot of money like flash loaning or some shit like that, flash trading. But
there's weird shit going on.
Yeah, there's like a lot of weird shit that they can make money off of. But basically they promise if you keep your money here on Luna, we'll give you 20% APY on the year, right? Which is a huge red flag, which is basically like, you're straight up scamming motherfuckers type shit.
Ponzi scheme.
Yeah.
And Tether is essentially following those lines, and Tether's one has, I think, over billions or maybe even trillions inside of it.
I think I read something. It was like 10. Don't quote me exactly, but in the magnitude, I think it was like 10x larger than USD.
Than USD. Okay.
Yeah.
Shit. That's fucking crazy.
Okay.
So if that blows up, Bitcoin's falling.
Yeah. Well, I mean, it's not a good thing for the system.
And I personally think it's a ticking time bomb. But
yeah, I agree. So there's a key thing that we have to hit on, that we have to go back to understand the rise of cryptocurrencies and other shitty investments. Well, I'm not calling crypto shitty yet.
Yeah.
But
not yet.
But there's a lot of speculative shit that came out in the last since 2008. So a key event happened in 2008. If you want to get really in depth to it, go watch The Big Short. But basically in 2008, the financial system crashed and it froze, like it broke. And the key thing was that there were banks creating these mortgage-backed securities, giving strippers 8 houses, whatever. And the
AAA double rated loans.
Was that like the ninja loans? Like no income, no job, and people are just getting
a lot of bad shit.
Yep.
Exactly.
And so at the same time, you had interest rates hitting there were weird shit built into these loans where basically you could get them really cheap in the front end, like not pay that much in interest, and then they like jump up at some point. And when they jumped up, like all these mortgages like defaulted, and to make matters worse, like they repackaged these like mortgages and then into fucking more like
another mortgage, basically just another shit.
Yeah, they took all the shitty ones and like put them all together and they repackage it so people think that they're getting something diversified. but they were all shit.
Yeah, they just called it
okay.
same shit, different name.
Yeah. So, but we'll get past that because the key point isn't the like housing crisis.
Yeah.
But the key thing is that a major financial player came into the market at that point, which is the Federal Reserve. And the Federal Reserve did something that basically they'd never done before, which they fixed or saved the financial system by buying bonds, or like basically buying fixed income securities. And what they started with buying like U.S. government bonds.
Mm-hmm.
And basically this kind of like support to the market became like a bit of an addiction. And what you see is that from 2010 to 2009 to let's say 2017, steadily they bought more and more and more of these bonds. Federal Reserve did is they started buying bonds. And what's important about that is that when they're buying these fixed income securities, they're doing it with money they printed. And it's not like they're in some factory and they had to get all the dollars. Like it's digital.
Yeah.
But it's creating new money. And this new money is being injected into the system through banks and through large financial like institutions like asset, like money managers. And once that money is created, it can go back into like investments. And the key thing is that our capitalist economy doesn't work without financing. Like we think of like you or I, it would be kind of tough if you couldn't meet certain payments with a credit card. So think about companies.
It would slow everything down.
Not only slow everything down, like certain companies that we know today would cease to exist if they couldn't access public funding markets.
Because you can't leverage?
Because they're massive and they can't possibly meet all of their liabilities or
financial
money obligations without drawing on some like credit lines, or for example, like without paying without physical cash.
Okay, gotcha. All right.
Okay, so but anyways, they started doing this. They did it all the way to 2017, and then basically they started like they tried to stop. So they tried to basically sell those bonds back to the market. And what happened when they did that was like a ton of different investments simultaneously were falling in value. And so like back then, Bitcoin I think peaked at like 19K. It went all the way down to like 3K.
Yes.
And S&P 500 I think had fallen like 20% into what was like December of 2018. And then like at that time it was kind of interesting because like Trump was basically pressuring the Federal Reserve to like stop. They were focusing on the interest rate portion of it. They were saying, oh, you need to cut rates. You need to stop talking about hiking rates, whatever. But the key thing that happened there was they made a complete U-turn on their behavior in buying or selling these fixed income securities. And so they stopped what they were doing.
They stopped selling.
Selling these bonds. And then COVID hit. And the amount of fixed income buying that they did during COVID was the most massive undertaking that had ever occurred. Yeah. It was massive. And basically what that did was, you have to think about, they weren't just buying US government bonds then. First, they were buying a lot of them, but they were buying other stuff too. So they bought at its peak up to 25% of the like United States government bond market. They were buying mortgage-backed securities, which are now like issued through like a government entity called like Fannie Mae, Freddie Mac. Yeah. Yep. And they were even buying corporate bonds, like Apple's bonds, for example, through an ETF. And what this does is it starts making like traditional investments like not make sense to own. And so I'll give you an example. US treasuries, like 10-year, 30-year treasuries, were yielding like 1%. And like money managers, their job is to not like, if you tell someone you're going to make them 1%, they're going to tell you go get fucked.
3% is like ideal,
Still
right?
shit, right?
Still shit.
Exactly.
Okay, fuck.
And so
S&P beats that.
No, okay, like the normal.
I thought 3% was a good deal.
No, it is on a fixed income security. But if you're a money manager, like you're usually telling someone that like they usually take like 2 and 20, which is like 2% of the assets under management, so 2% of what they gave you to invest, and 20% of the returns. So these guys are trying to make 20, 30%. Like they're trying to make serious amounts of money. And so what happened is, because of what the Federal Reserve did, all of those investment like institutions start investing in riskier assets. And so that starts with allocating more money to stocks. And now like Apple and like these big, I would call them relatively safe tech companies that have businesses that can kind of withstand anything. Like nobody's not going to buy Apple iPhones.
But they're overinflated.
They start becoming expensive. Like these companies start trading at the highest like price
Amazon,
relative.
Apple,
Yeah. And
Tesla.
so what do people start doing? They start buying like just shit companies, like companies that have no potential to like ever make money. And even those companies get expensive. So you start seeing like other types of like really garbage stuff going out there, like the SPACs.
Like GameStop and like SPACs.
I mean, GameStop has a real business. I'm talking like worse than that, like SPACs.
Like Nikola?
Like these companies that made up their financial projections. They weren't fucking ever going to hit it. Crypto is definitely it's definitely part of the more like pushing into riskier accesses of the financial
assets.
markets.
Okay, cool.
Dogecoin.
Yeah.
Oh god.
Dogecoin.
Dog money, baby.
Dogecoin.
and then also like pushing into more like leveraged like option like risk, basically anywhere that risk existed, money was flowing there. And the last one I forgot to say, but this is like private investment. So like all of those funding of like all the fucking grocery store, like grocery delivery businesses in New York City, or like any.
Oh yeah, like crazy evaluations. There were like a grocery was like
money.
Was like $1 billion or some shit. One deli was fucking valued at that. I was like, what the fuck?
Yeah.
Fucking I was like, what the fuck?
That was probably some other shady shit.
Yeah, that was like that's definitely some
That was
fucking
definitely some
wild
shady shit
shady
going on.
laundering shit.
But yeah, okay, so like that's the huge like background that we need to start with to talk about anything that was like happened over the last like 3 or 4
3
years.
weeks. Oh, 3 or 4. Okay.
Well, like
years.
3 or 4, like for example, like people started talking about investments because
Everybody was home. Or
that.
I think even a little before that, like right when the pandemic hit, like now you have Robinhood and now everything crashed and everything just shot up in the span of a few weeks. So everyone's like, you got all these new traders that are like, dude, all you gotta do is put money into this and you make money back. It's easy, you know?
NFTs too. I forgot that one.
Oh,
There you
NFTs.
go.
We can talk about NFTs too. Soon. Any more points you want to make on the last 3 years?
I'm basically saying is that this access of like money in the system that couldn't buy traditional investments because the returns were expected to be too low created what is obvious now, a bubble in things that like should never have gotten so expensive. And that's really key to understand, because what happened in the last, we'll call it since November, but it's really been happening since like early 2021, has been the reversal of that kind of like bubble. Like
since 2021 we've been reversing that bubble.